Server Dave here. I've been out for a few days because of work and real life stuff, but I'm back. And there's some interesting news today. Janet Yellen, most likely Monday, she's going to be the Treasury Secretary. And that's big news. Let's find out. So, Janet Yellen, Treasury Secretary. There was a panel hearing, according to the news, everybody, both sides, Democrats, Republicans, they love her. She has, I think, a unanimous pass from the 26 members of the panel, which is 50-50 Republican, 50% Republican, 50% Democrat. And it's really important to understand why, Yellen is such a big deal. It's because Yellen is very accommodative. And Joe Biden wants to do a $1.9 trillion stimulus plan. So guess what? They're going to be issuing of government bonds. And why are government bonds so important? Because if you want to do quantitative easing, you've heard about Jerome Powell and his money machine go brr. Well, if you really want to go big with money machine go brr, you need bonds, and you need bonds to circulate, and this is how it works, and this is why it makes everything go up. First thing you know is that when the government issues government bonds, it needs to go through an auction. The Federal Reserve can't just pump money and buy bonds. That's not in their mandate. The Federal Reserve can print money and it can give money to the banks. So what happens? Well, different banks, your bank bros, they go like, hey, government, we're your friends. We can make a market for you. We have all these clients, we have these pension funds. We have our pension funds. We have our ultra high net worth individuals. We represent these people. We can work on your behalf and buy your bonds, And they're like, okay, you sure about this? They're like, yeah, we'll go to the auction and we'll bid on it. So the government issues their bonds. They're like, okay, here are our bonds. You guys want to bid on these? They're like, yeah. So they don't use their money. They use money from their clients, right? Their clients, the little piggy banks. They're like, okay, here's the money. Give us those bonds. They're like, okay, so we give the bonds to here. There's a transaction. The bonds come out. And the bank's like, okay, thank you for the bonds. Here, we pay you this amount to finance your budget so you can do stimulus. And our bonds, we give it either to our, the people who give us the money, or in this case, which is very interesting, they're like, hey, guys who give us the money, right? We're using your money. The Federal Reserve wants the bonds too, but they're willing to pay an even higher price than what we pay. We pay how many money bags? 1, 2, 3, 4, 5, 6. We pay 12 money bags. The Federal Reserve wants to pay 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. They want to pay 15 money. They want to pay 12, 16, 17 money bags. And they're willing to do that. Are you willing to make the deal and sell your bonds to the Federal Reserve? And like most normal good institutions, they're like, of course we want to sell our bonds to the Federal Reserve. Here, give us the money from the Federal Reserve, and then we will take the bonds. The Federal Reserve, yes, money printer goes brr, and they take this money and they give it through the banks. So first it goes to the banks take a small cut, right, and they give it to your pension fund. Your pension fund, yay, we sold our assets, we increased the book value of our assets. The bank takes its commission and its fees, and then the bonds go to the Federal Reserve. I should make this bigger. I will zoom out in a bit. And it goes to the Federal Reserve. So here it is, Federal Reserve. They've got the assets. Okay, what happens next? Well, then we have all of this money, right, in these pension funds. They're like, oh, we still need to diversify. We still need growth because people are, they're retiring and, there's stimulus going on. So the government gave people stimulus. They're like, hey, here's some money, go buy stuff. And people are like, oh, I'm worried that, I won't have retirement because everything's getting more and more expensive. I might want a few Christmas trees from these industries, But you know what? I'm gonna spend like half of it on these Christmas trees, and I want to spend you know, a little bit onto these food pieces, and guess what? The rest I want to save. So they give a little bit here, and the rest are like, hey, pension funds, institutional investors, here, piggy bank, right? Have some more money. So you're the little piggy, you use all your stimulus, you put it into your brokerage, into your 401k. They're like, okay, now you tell them, we need to invest it. What do? We need some investments. Oops, that was a problem. So we need some investments. We want to get returns. You know, we're going to retire. We know that the money printer will keep on going brr and devaluing the currency. So what can you do to give us returns? And your pension fund's like, oh crap, we sold our bonds, so there's no interest payments. They talk to their bankers. They're like, hey, can you get us some more of those sweet bonds? They're like, yep, we can buy them back from the Federal Reserve. But the Federal Reserve, you know, they're not going, the bond is so expensive that they sell. Do you really want it? The real interest rate is negative. You're like, oh no, that's a terrible idea. So your bankers go, hey bro, I got an idea. We got something called stocks, you know, stonks. And your institutional investor's like, ooh, stonks, they sound a little bit dangerous. They're like, don't worry, these are good stonks. And we talked to our good friends here, these captains of industry, and their stonks all go up. And you're like, okay. That's what the institutional investor's like, okay, well, help us acquire some of these stonks. So these stonks, right? They go, your Jeff Bezoses, your Elon Musks of the world. They're like, okay, I can monetize a bit of my company and get a ton of money for it. Doesn't sound like a bad idea. Plus, I'm not making so many big sales, you know. We need financing. It sounds good. Hey, let's give this stonks onto the market, right? And how much are you institutional investors willing to pay for these stonks? Well, they're like, we got a bunch of money, you know. Before we used to have half as much before we sold our bonds to the Federal Reserve. You know what? Let's use like half of it. You know, it sounds reasonable. Boom, and we got stonks. And it's self-fulfilling because every time, you know, you buy more of these stonks, you buy the listed price, it's the last listed price. On the books, it looks great. You know, they can issue as many stonks as they want. They're like, yay, look, oh wow, there's new stonks coming onto the market and people are buying it at high prices. You know, other piggy banks are like, yay, we should buy more stonks. Anyways, that's how the stock market is going to go up because now, you know, the new price of the stocks is much higher and the nominal value paid for the asset is higher. And there is one more thing. You know, you've been paying these people for, they've been getting all this money. Your captains of industry are getting a ton of money. You know, they've sold their stonks for cash. Our bankers, they take their fees. You know, they've been getting a little bit of money. They're happy. They're like, we're everybody's friend. We're making the market happen. You know, you're going through us, you're paying your fees. It's not so much, it's like 1 or 2%, but think about it. If the money goes around three times, that's 6% of the money. So, so yeah, one time it's not so much, but if it goes around 6 times, it's quite a bit. But anyways, so now your captains of industry are very well capitalized. I mean, I think the richest people in America have made a few $1 trillion over the course of the last year. And it's not just them, but it's actually the value of their companies. And they've been getting cash in exchange for their paper securities that grant partial, like a very small partial ownership of their companies, but they maintain control because you need more than 51% to kick them out and take over their company. But in most cases, most of these owners have a large share and they're very hard to remove from their companies. So they're like, okay, well, you know, we've been making like these products here and people are trying to buy it. But you know, there's not such great demand, but we're scared that in the future, right, these resources, right, like this land, this ore, this oil that's used to make plastics, the land to build our factories on, the metals, you know, the silver, the gold needed to make computers, to make, I don't know, nickel used to make electrical vehicles. It's gonna get expensive because, you know, it's not just we are bidding on these in the US, but every single country's bidding on it. Everybody's doing quantitative easing. Everybody has money. We should stockpile a bit of this. Yeah, it's not a bad idea. And they're like, okay, let's go and buy everything that's not in this closed system. Because you think about it, the financial market, right? It's somewhat closed. It's circular. It rotates within itself. Now you look at the picture, you're like, yeah, it doesn't seem to move outside. Now we're talking about everything that's outside of the inner circle of this money circulation. And that's where imports and exports come in. And they use a dollar. Dollar is a world reserve currency. It's very easy for these captains of industry to go, I want to buy a lot of stuff. So they take their dollars. They don't even have to convert to the dollar. Other countries do. They have this initial advantage that they don't need to convert it to the dollar. And they're like, okay, let's go and buy stuff. So they go to like countries like Saudi Arabia. They're like, we need some more oil. They're like, okay, here's some oil. Oh yeah, we need some land to build a new gigafactory. Oh, here's some dollars for that. We need all the nickel in the world, you know, to make all our EVs. So they're buying this stuff, they're buying this stuff. And guess what? Well, this stuff going here, now the cost of buying these items go up and the prices go up. So what has gone up in this whole process? Well, the cost of commodities will go up in the end after stocks. The first thing that moves up are stocks, bond prices, stock prices, and then commodity prices finally move up. Now, this is a part that's a bit controversial because the Federal Reserve is like, we are going to keep supporting you doing this as long as we don't see that these hot dogs, right? Oh, God, again, that these hot dogs, the price of these hot dogs and Christmas trees, you know, they don't go up. And that, you know, the home prices, we don't take this into consideration, right? Because it's not consumed and people can always refinance homes and, you know, get more cash and so on, their assets, and that's not part of the system. Well, what happens here? What happens if the price of these things go up? Well, the captains of industry, they care about profit. They care about making as much money as possible. So they're going to go like, okay, we are going to reduce the amount we use of each one of these, right? Land, oil, and so on, with something called technology. And we're going to sell like the hot dog, but for less of a price. And this is the part where, you know, it gets complicated. If the Federal Reserve only considers the price of like the things that, you know, us, the little piggies, consume, it will never end because technology is always inflationary and technology is exponential. So, so the price, even if the price of oil, let's say, goes up, we'll find some new ways to like reduce the price of packaging. If the price of land goes up, we'll find new ways to outsource to different countries, you know, where land is cheaper. We'll move it around. If primary like resources, let's say like today, we decide that we want to make most of our EVs use silver in their batteries for the anodes. And we're like, or for the connectors. And we're like, okay, silver's getting pricier. What can we use? Well, they'll move on to copper. It's a less great material, but it's cheaper. So you can still buy like your EV Christmas tree or EV car, but I'm using the Christmas tree as like a representation of goods. You know, you can still buy it for this roughly the same price. Look at the price of telephones, right? Of course, the latest iPhone is always getting more and more expensive, but all the mid-tier phones that are much better than last year phones, they're not getting more expensive. All your like Samsung mid-tier phones, your like generic Android phones, they're not getting more expensive. Every year, even some of them are getting cheaper and cheaper and then more functionality. So technology is deflationary. And if you are the Federal Reserve and you're looking at the CPI, and you in your CPI, what you consider is consumable goods that are impacted by deflationary technology, you will keep doing the money printer. And here is what I think will happen. I think that, you know, because there's going to be continuous money printer, there's going to be, even if they give you a $1,000 stimulus plan, it's not enough to like wipe out all of the debts that people have incurred. If people also have individual debt, they've got student loan debt, they're actually in negative dollars. The average American is in, I think, negative $10,000 in personal debt, from student loans to credit card to mortgages. So yeah, you times it by 300 million, you've got like a big number. You're not looking at a 1.9 trillion. You need like a $19 trillion, not a 1.9 trillion, but a $19 trillion, stimulus plan to really like take people out of the debt system and to wipe out the debt. And so if you just do if you trickle 1.9 trillion, you will never be able to finish. You will never be able to clear the debt situation, and you won't even be able to print away the debt. So what will happen is, I think for the next 5 to 10 years, we're going to see continuous money printing programs. That means the federal government is going to issue stimulus. They will want to put money into the hands of people. They will issue government debt. This debt will be bought up by intermediaries, that is, institutional investors, pension funds, and so on, and done through your banks, Wall Street banks, typical Wall Street banks. And then the Federal Reserve will come in, it will buy a portion of that, driving the prices of bonds up. They'll get more and more bonds on their balance sheet. And then as these institutional investors sell their bonds to the pension funds, they actually get money, and they need to put this money somewhere. And the only other place they can put it is either they can put it into the stock market. Many of them are not allowed to buy gold. So maybe some of them who are allowed to buy gold and silver and commodities directly might decide to put it into commodities. But also the businesses that are monetizing their corporate securities, they will have the ability to use that money and go and buy primary resources to fuel production. But as more they buy, these primary resources and commodities the price is going to go up. So at the same time, they are going to try and invent new ways to make manufacturing cheaper. And it leads to this deflationary cycle where, your commodities might be going up in price, but the final product is not more expensive. And that is how, you have a perpetual quantitative easing, and you don't have inflation. That's how it works. And we are currently in a global economy where there is an abundant resource of labor, capital, and continuous technological innovation, automation. That's something that in the 1900s took forever to do. Automation today is progressing at the speed of light. We're really quickly automating the way people do analysis, production planning, manufacturing, not just making the stuff, but also the planning. The middle management's getting replaced by AI. That's what companies like Palantir, they're trying to do. They're trying to replace the whole decision making and middle management part with artificial intelligence, especially in terms of operations. You decide what production chain to cut off or how much to produce. Traditionally you use an analyst, but with AI you can do projections automatically with computer systems. And that's kind of what I've been doing with my machine learning stock market predictors, which is, instead of using an analyst to do long-term predictions, I'm not a bank, I don't have resources to hire an analyst to sit down and do the math for me and to look at different markets. I would just run the algorithm, and it would do the analysis based upon different indicators across all markets, and then present me with his projection and how it got there. That's the power of AI and automation, and it will make things cheaper. And I think this is why Yellen is really important, because Yellen, she's at the root of it, and she will issue many bonds. That's the gist of it. Yellen and Biden issue many bonds, will make more money machine go brr happen around the world, and it's going to be a very profitable period for banks. It's going to be a very profitable period for captains of industry, and maybe not profitable. I would say it would make their companies be valued more on the stock exchange for as long as this thing can keep on going. It will devalue the value of the bond. It will devalue the value of the dollar, and it will tend to increase the value of commodities. And I think we're already seeing this happen. We're seeing land get more expensive, housing getting more expensive, nickel, copper, all the base commodities have been on sort of a upward trend since March. Right, there's an initial crash, but they've all recovered. Oil is heading towards 50. It's in the $50. Maybe it'll go towards the $60 range. It's got some downward pressure and upward pressure, but as things pick up and countries start stockpiling oil for manufacturing, we will see the price of oil go up. And the final price, if the Federal Reserve purely benchmarks their how much money printing they're willing to do and collaborate with the government on how much people consume hot dogs and Christmas trees, or basically consumer products, that will be very interesting. That will be pretty much they will never stop, because these products will get cheaper, the margins will get bigger, the quality might go down, but they won't be able to measure it. And so if you're stacking gold, I think you're in a good position. You're stacking silver, you're in a good position. You're stacking platinum. I picked up some platinum coins, bullion coins, and I have been buying I've been picking up platinum and other assets, but it's clear that we're going to head into something that's similar to the Roaring '20s. This is not financial advice. This is just this is trying to explain a complex situation in a very simple manner. And it's not financial advice. You should not trade based off, random pictures of famous people. None of these people, except for we know that the Federal Reserve and Janet Yellen, they are the public figures. The other are private people. They are not necessarily the ones that we're going to talk that are doing this, but it is people in similar positions. That means banks, industries, not necessarily Elon Musk is not going to go out and buy tons of oil. It's more like, there will be manufacturing industries that make plastics that will buy a lot of the middle distillates in oil. There will be factories built on land. There will be companies buying up nickel and so on, not necessarily Tesla or Amazon, but similar companies, including those companies too, but similar companies. Anyways, that was today's video. I will show my platinum coins that I picked up recently in another video, probably coming out also today or maybe tomorrow. If you like the content, click the like button, click the subscribe button, and thank you very much for watching. This is Dave.